All right, after reversing yesterday's bearish day with a pretty good move to the upside by the end of the day, and a really good start to the morning after the non-farm payrolls came out, the news about the gas in Europe, natural gas in Europe, and the Nord Stream pipeline being shut down really sent the markets down pretty much to the lows of the day, the lows of the week, right? Retesting those lows of the week and about as bearish of a close as we could get from a technical perspective. So I'm going to break down kind of the damage that we ultimately ended up having, that we were so close to avoiding, but we ultimately ended up having on not only the daily charts, but also on some of these weekly indicators. So I'm going to break that down in today's class. We're going to take a look at what's driving, what was so bullish initially, and then ultimately what turned out to be pretty bearish by the time we got done. And then we're going to take a look at a trade idea in the stock that's breaking down itself and is looking it's got its own damage, and we'll talk about how to trade that a little different way than what we normally trade with this particular option strategies, and we'll talk about what that means and how we did it, and let's go ahead and get started. Today is Friday, September the 2nd, 2022. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, before we get started, I invite you to subscribe to our YouTube channel with that icon right here in the bottom right corner of your screen, or down below with that subscribe button. Hit that thumbs up icon down there, like our video, comment on anything that stood out to you. Join our website at MarketScholars.com with that link up there in the top right corner of your screen. Follow me on Twitter for more content between the videos from day to day, and join our Market Outlook Facebook group that we've created. All right, if you're watching us here on our blog, check out some of these other things here on the right, including our Market Outlook live video and our upcoming trading rooms. Come down to the bottom, click this heart, it opens up that tab. Hit that like button that pops out there, right there. Click on this thumbs up icon, it opens up another new tab. Hit that like button. Again, the more you do that, it really helps us because it helps get our content out to all of our followers on these social media platforms. All right, well, let's start off taking a look at the S&P 500 with the market forecast indicator. You can see we finished the week. So we started the week last Friday only 1.5% below the 30-day moving average. We finished the week nearly 5% below, 4.75% below the 30-day moving average. So just like that, we have we are in an intermediate decline. Like that's like when you get more than 2.5% below, you are in an intermediate decline. Now, granted, we haven't really started yet because we haven't broken this 23% retracement level, which is this green one, which is again, that's the last intermediate decline that we had. And this is the retracement of that intermediate decline that we still haven't ended. We don't end the retracement until you break back below the 23% line or above the 78% and change the impulse move to the upside. So that kind of gives you an idea, like, we're already that far below. I mean, the 30-day moving average got up almost to the 50% level there, and got up above this long-term 38% of the year-to-date decline. And so that kind of gives you an idea, like how bearish we could be before we even start, because of the significant retracement that right here. This move right here is probably it's turned out to be a fake out, right? And again, as much of a fake out as that was at the end of March, this is turning out, or could very well turn out to be, a lot more significant of a fake out there. I think I mentioned to you before, on a weekly basis, we didn't get the bear tag there. And these bear tags, on a weekly chart, mind you, will either be significantly bullish or lead to a new bear market. That's what it's done in the past. And that's 3 weeks later, when we talked about that 3 weeks ago on that Friday market forecast. 3 weeks later, we are now that much lower and more likely about to start. We're back to dark pink shading in a red line. We are 5% below the 30-week moving average. Again, you can kind of see how far down we got there when we got the cluster in June. We have the near-term line and the momentum line down below the 5th percentile for the third time. See that the last time when we came off of this March peak, we also had a very bearish short-term sentiment, market sentiment line 3 weeks after the fake out week. So we had the fake out week. 3 weeks later, we got back to dark pink shading in a red line, and you had very bearish short-term sentiment with the intermediate line crossing below 50. Well, guess what? Fake out week, 3 weeks, 3 weeks later, 3 weeks later, you are back to dark pink shading in a red line. You have very bearish short-term sentiment and the intermediate line dropping back down below 50 and staying below its market sentiment line in the process. So needless to say, we are like, obviously you've got, bearish reversal patterns. When you look at it on the weekly chart here, you've got bearish reversal patterns. You got the red arrow last week. That's a pretty significant bearish candle this week. And considering that we ended up closing at the lows, we could have actually closed near the highs of the week, but instead we ended up closing near the lows. And so now we'll probably more than likely end up with a pretty bearish Heikin-Ashi candle next week, barring a significant jump to the upside. We've looked at the whole moving average before, and you can see how bearish that whole was. And then now you're going to get a pretty bearish candle. I mean, ended up with a higher close, but considering, again, that we closed near the lows and not near the highs of the day, that we're probably going to end up with instead of a bullish candle on Tuesday, we're going to end up with at least the beginnings of a bearish candle with a lower close. So that's how significant the close was, the fact that we didn't hold those really early morning highs. If you look at the weekly chart, though, on the whole, again, this would be the 20-week whole and the 200-week. A very significant change when it turns red. We're obviously well below that, and we can again washed out there at that week in June, mid-June. But just like that, we don't have a red line on the whole. We had a 3-week pattern there of bullishness. We had about a 5-week pattern here of bullishness. Where we popped the parabolic stars in the opposite direction. Did it again here too. Obviously, if we're going to pop the parabolic star up next week, because it's going to probably be up right around 3,900 next week, then that's where we'd have to get down to pop it back up to the upside. And at the same time, we'd most likely be breaking down below this long-term 23% retracement. That's since the year-to-date decline. So you can see how bearish we are now on this weekly basis. It's a pretty significant bearish candle. Now these weekly declines don't last very long, as you can tell, before you get some transition candles. So they tend to be a little bit more, like right now we're not getting the gradual declines that you typically get during bullish moves, where they're just really small. Like we are below the 200 week, we're well below the 200 week. When you look at the 3 green arrow chart here, when you expand out the lines, we failed to get back above the 50-day moving average today when it looked like we could. We failed to get back above the 8-day, and we extended even further, like below it. MACD is dropping well below its moving average, and it's negative. Stochastics is about as extremely bearish as you can be. We looked at this stochastic study. I talked about before how, how bearish that is to get 4 straight days of the stochastics being in the 10th percentile. Well, now we've got 5 out of 6 days of the stochastics finishing in the lowest decile of the 4-week range. That's pretty bearish. We just don't get that. You can see typically you bounce, you almost immediately bounce. And you'd expect that we'll probably more than likely bounce off to some degree on Tuesday, to a small degree. But there's a lot of damage that was done from a technical perspective today. Obviously, you've got 3 red arrows. So again, this tells you this is not like we are on an intermediate decline. We're not going to bounce right back up to new high here, at least to a new intermediate high. We're going to be down here for a while. We got pink shading and a red line on all the indexes. IWM is holding up a little bit better than what you see on some of these other charts. If you go to the DMI and the ADX is still above 20. The negative indicator is still above 30. The positive did jump up today because we did get such a higher high. So that helped that positive indicator jump up. If you look at it on the weekly chart, it's the other way around. The negative indicator has jumped up significantly, with the positive getting back below 20. So you had a really significant bearish crossover there with a persistent high ADX on the DMI. When you look at the RSI and the CCI, again, we were back in at least neutral territory. We were back above 40. We were easily above negative 100, but because of how we ended up down. And so that's on the daily chart, and of course on the weekly chart, we're moving back down with failing to get to bullish levels. So on a long-term basis, we're still in bearish ranges where you peak just a little bit above 50 and you bottom out, down here below 40, and you wash out below 30 eventually at some point in time, at the end of the bear market usually. You wash out below 40 there. When you look at the Bollinger Bands, you can see we are back. We have been in the lowest quartile for the whole week. We continue to be in the lowest quartile for the week. If you look at it with the Keltner channel, we are below the channel. We're in between the bands in the Keltner channel. The momentum is moving pretty strongly to the downside with green dots. We never did get red dots. We just went from being above the Keltner to below the lower Keltner. So pretty bearish from that perspective. On a weekly chart, we also dropped back down into the lowest quartile of the weekly bandwidth. And those bands did jump back into the Keltner channels. And so you're setting up for a new long-term leg lower to the downside. And that also shows up as well on the Ichimoku cloud. Right? We are the beginnings of a bearish cloud. I mentioned how important it is when we get the green shading that we stay above it, that we don't get back below it by the time we get to the green shading, because that's pretty bearish when you're below the green shading by the time it turns green, right? When you've been bearish. So there we are there. And then if you look at it on a long-term basis, we drop below the green shading. We're almost to the pink. If we're going to maintain, so you can see here, we got below the green shading. By the time it got pink, because the pink is this move plotted forward 26 weeks, 26 periods, in this case a weekly period. So by the time you got to the pink shading, we were right back above. So 6 months later, the correction was over with, right? And we were pretty good. Same thing over here. In 2018, by the time you got to the pink shading, you were easily above it. So everything was fine. You were back to a good bullish trend by then. You were back to a good bullish trend by then there. This pink shading is by the next month. So we have within the next month to get a bullish trend started and to get back above the pink shading, which appears unlikely considering that we are back below the blue line and we failed to get above the cloud. We've seen this before, right? The last bear market that we had, we failed to get above the cloud. We got above the blue line, failed to get above the cloud. By the time we got to the pink shading, we're still below it with a new bearish trend developed on a long-term basis that eventually turned into this bear market. So that appears to be, we had the bearish trend. It ended on this correction bounce, and it appears that we might be headed towards the beginnings of the new leg lower to the downside. That ultimately gets us down to the 200-week moving average, right, which we still haven't tested yet. Gets us down to that 200-week moving average, which by the time we get there, it might actually be up towards those June lows. And then the test, is to get, do we stay above it? Because you can see there's not very much volume below us. Like below these dotted lines where there is a little bit of support, because we moved up so fast there in that reopening trade from November to March of 21, November 2020 from the election to March of 21, there's not hardly any volume until you get back down below the pre-COVID high, down towards 300. That's where the volume kicks in. And the other thing too about not only do you have those dotted lines there that I mentioned that are really, really important, as well as that long-term Fibonacci level. So both these two, the red and the black, very significant, very long-term, because of the long-term, how significant they are. But you also have the value area, the purple line. We've been above the value area because we've been so bullish, but getting back into the value area typically means that you get pulled back towards the point of control, either to the upside or the downside, depending upon which way you're entering the value area. And so here's the problem, is if we get back into the value area, especially with very little volume below us, and you have a lot more volume, you actually have more volume above us right now than you do below us on this 5-year chart, then that opens us up to it makes us a lot more susceptible. We've already failed once to get below those two really important lines. The 23 is based off the 2009 low. The 38% is based off this COVID low. So we've already failed once. A little bit of a fake out there because the next week we filled in the gap and then got back above those lines. When you get a fake out and then you end up doing it again, the next time usually doesn't end up being a fake out. And so again, getting into the value area, getting below those lines would probably send us towards the bottom of this Fibonacci retracement zone, down to the 38% line of the long term, as well as the 62% line. That puts us down towards 320, and that would be easily below the 200-week moving average, and more than likely would be the signal that we've started the bear market. Like once you cross, you start the bear market. So you'll cross that 200-week moving average. There's going to be a period where you try to retest, right? Generally, anytime you cross a major support level, or a resistance on the upside, you tend to retest it first, and that solidifies it. And so the correction gets you to it, you bounce, you fail, then you get back down to it, and you break through pretty easily, get to new lows. You make a retest move, in this case up to the 17-week, but just right below the 200-week, and then it fails, we reverse, and things really hit the fan, right? That's, again, if we could get down here to this 38.62, it fails, we come up a little bit, and you work your way back down, again, looking at COVID lows as, that 62% retracement of this long-term, that's, again, there's no volume there, relatively speaking, over the last 20 years. That's where a bear market will take you. And to kind of give you an idea too, like from a linear regression standpoint, if I were to look at the linear regression here, when you look at, like, we think, oh, we've been really bearish, look how bearish. When you go back to December 26th of 2018, there's a reason why we bounced up so sharply off of that level, right? We were down 2 standard deviations below the 10-year mean. So that's pretty bearish, and we bounced as a result of that. When you do the same thing for COVID, I'm not exactly sure the exact date, but it's somewhere in the middle of March of 2020. When you do the same thing for COVID, let's leave it at that and go to 2010, then you can see we got 2 standard deviations below this 10-year mean. And the deviations got wider because we got more volatile. Well, now, again, we're even wider now than we were then because things have been more volatile. We are not at 2 standard deviations below. And if we do get down to 2 standard deviations below, which on SPX would be a move down towards 3,000, right? Just barely over 3,000. Well, to kind of give you an idea of where that's at, relatively speaking, with those Fibonacci levels, a move down towards 3,000, maybe a little bit above it, would be down into this area, right in here, right? Or a little, maybe 3,100, because that's what that line is. That line is that linear regression line. I just plotted it forward a little bit so to make it easier to see. So if I were to add some more candles over to the right, so by the end of the year, you're looking at about 3,150. If that's where we ultimately get down to, 3,150. So that would be 315 on SPY, right? So that puts us right pretty much down towards this 38.62% retracement. And then you get, again, that would be this move from, if you're going to use this as an analog, it would be this move right here that gets you below the 200-week, starts you on the bear market, and then obviously probably towards the end of the year, beginning of next year, you get your retest right there into the 200-week. With the seasonality of December and November, December, kind of January timeframe will probably get you a bounce up to that 17-week. But that puts you down into here, and then you bounce up, and then 2023 ends up being what 2008 was for us. Now, I think what we're more likely going to get is, instead of a 2008 type bear market, because you didn't have technology and discretionary and communication services, such a wide disparity, I think instead the bear market's going to look more like this one, where you break down, this was the correction bounce, you broke the 200-week, you kind of retest a little bit here, and then over the next couple of years, you slowly work your way down. See, if it wasn't for 9/11, we were pretty bearish going into 9/11, but then 9/11 happened, and things obviously was really bad on multiple levels. But then you quickly recovered. So technically, we were kind of just steadily dropping here and kind of converging. Aside from that anomaly, from a stock market perspective, of course, it was not an anomaly in and of itself. But from a stock market, you can see we dropped, we immediately rebounded. So we were pretty steadily dropping and converging before things really hit and washed out there in July of 2002. This is the type of bear market I expect that we'll get, where it'll be a kind of a steady decline, right? Again, it's going to be a little different because I don't anticipate a major terrorist event on U.S. soil like we saw, and I hope we never see that again. But aside from that, it was pretty gradual decline until we washed out, and then we had our real bear market rallies. I mean, these kind of rip your face off rallies there. This is not a bear market rally, right? These are when you're actually in a bear market, these are bear market rallies right there. And this is the type, again, of bear market I expect that we'll see over the next 12, 18 months, potentially heading in towards the 2024 presidential national election. Let's take a look now at the volatility charts and see how it ended. You notice we did ramp up again. This kind of goes to show that we're just in the beginning stages of a new leg lower, because we are not washing out on volatility. Volatility is still pretty darn low, 25 and barely above 95%. So we're not closing. If you look at it on a weekly basis, we barely close higher. As bearish as we were this week, volatility barely closed higher this week. We closed at 25.56 last week. We closed at 25.47 this week. We barely closed higher on volatility, and the stock market itself was down whatever it was down, right? The stochastics. See the price moves here, and then we'll go to a 5-year weekly. If you had 2 consecutive weeks of 3% declines. The difference is when you look at these last 3 weeks, 1%, 3%, 3%. If you look at those last 3 weeks, the VIX rallied 5.5% that first week. It rallied 24% last week, and with just as big of a move to the downside this week on the S&P, the VIX here says it actually fell 1/3%. It was basically break even. So again, it goes to show that the VIX is still pretty darn low, relatively speaking, to where, so here it is relative to, there's the VIX relative to where it's been, implied volatility. And historical volatility is also really low. Again, we don't typically bottom out on these legs lower until volatility is a lot higher, right? The volatility, the historical gets pretty darn close to matching the implied by the time we end up bottoming out. This is where we bottomed out there in mid-June, and this is where we bottomed out here in right in this area, in the March area, and we rallied into right in here. So this is where we bottomed out here, and you can see historical volatility pretty much matched implied by the time we started to bounce up into the end of the month. All right. So one last chart, looking at the volume and trading range today. So we ended up with 99 million. That's the second Friday we've had more than 1.5 times the average volume on the day. And then today's range was more than double. Again, the second consecutive Friday we've had a significant range with a lot of volume. So 99 million shares is right there. It's above average, but not off the charts. 11 points is almost off the charts, but not extreme. That's sustainable, right? I mean, that's the concern is when you are hoping that we get enough selling that we can just bounce as a washout, you want the volume and the trading range to be off the charts in that one day. And that just wasn't the case today. This is, when you look at the volume here on this chart, you can see when you're washing out here, you want that volume to be huge, relatively speaking. Here it was huge, here it was huge, and then over here in some of these moves, it was huge. This is bigger than the average, but it's not huge. It's not off the charts huge, up to this, what, 173 to 200 million. That's not off the charts when you compare it to the average over the course of the year. See, the average peaked at 140. So you'd be looking for 170 to 200 million shares to be kind of off the, quote unquote, off the charts to signify that we washed out, and obviously not the case today. What do you think? Do you agree with that? Do you disagree? Let me know in the comment section below, especially if you disagree on whether or not, how bullish or how bearish you are, and then share what your thoughts there and what's driving your thoughts in the comment section down below. All right, now let's take a look at what's driving the price action. You can see early in the day we had a pretty significant jump in commodities, but stocks rallied with it. Remember, that relationship between commodities and stocks had been negative for pretty much most of the year, but it appears that that relationship kind of was breaking the last few days and then into this morning until this afternoon. And this afternoon, commodity prices stayed high. The dollar rallied off of lows. Yields actually stayed down because bonds really jumped up, and stocks fell like a rock. The S&P was up 1.25% at one point in time, along with IWM. The Q is pretty much all together there, just under 1.25%. At their lows, the Qs were down 2%. SPY was down 1.5%, and IWM was down about 1.25%. And then they came off their highs going into the close of the session, or lows come into the close of the session. It's a pretty significant change in direction there. Of course, remember, it was a bearish week overall. You can see, but unlike other weeks where we've been bearish, commodities and the dollar are usually bullish. But you can see going into today, commodities actually had the biggest decline for the week. Bond yields were up and the dollar was up, but commodities weren't up. And so that was the break, right, where commodities really dropped. Commodities and the yields were up on Monday, and then commodities dropped like a rock the next 3 days, along with equities. And even bounced up with equities there before falling, and then everybody kind of dropped there. So, pretty much a true risk-off day. The only asset class that was up for the week was the U.S. dollar, and the U.S. dollar finally broke above the highs of the past couple weeks, and then the high from July. So a little bit of a breakout. Now we'll see. It's 2 days. We'll see if it holds. It ends up, not being a fake out, but that's a pretty decent breakout there. You look at bonds, and bonds broke down yesterday, the same time that the dollar broke up. Remember, that means that yields are rising. So if you look at the 10-year yield, which isn't exactly the TLT, but you can see it jumped up yesterday and got up actually to pretty close to 3.25% before pulling back a little bit here today, easily still above the 8-day moving average. In fact, that's starting to have ripple effects. In fact, when you look at the mortgage rates here, mortgage rates have jumped back above 6%. Yesterday they got up to 6.25% before falling down today back to 6.02%. But 6.25%, remember, we peaked at 6.28% back here mid-June when stocks were at their lows, right? Back in mid-June right there, stocks were at their lows, yields were at their highs, mortgage rates are right back at that. So it kind of goes to show one of the reasons why we're still pretty significantly bearish, even if the S&P still is not quite down to its lows. We're getting, these big moves in the dollar and yields, even if commodities have kind of broken down themselves. If you look at commodity basket in general, then you look at like crude oil, which is below its 200-day moving average, and is breaking back below the 62% retracement of this bullish move that we've had that peaked earlier this year on the Russia invasion of Ukraine. So we're back in, of course, the point of control is down here at 82, but that's after kind of double topping and then topping again there in mid-June with other equities. It's now what we've dropped from 122 down to 85 essentially. Pretty good drop in crude oil prices, and of course much has been made about the drop in gasoline prices, dropping way below its 200-day moving average and dropping all the way back down to the 78% retracement level Just for some perspective on how low that is, because that's what we've been talking about, right? Well, there it is. That's where we are, and that's where we were in the past. Like, it's still a higher price from a gasoline standpoint that we had pretty much in 2015, 16, 17, 18, 19, 20, 21. It just exceeded that and exceeded all these other levels here in 2022, and now we've pulled back to that 78% and to the 50% retracement level of the long-term post-COVID rally in gasoline. So, and as of right now, we've kind of held support there, barely. Right, the MACD is about as low as it's been. So very significant bearish momentum there. A little bit of a washout type momentum when you look at the DMI for gasoline. You can see like the ADX is, kind of made a second high up above 40. If you look at the weekly version of it, that the ADX is already near 30 with the jump there. And when you look at it, whenever I cut this in half to look at kind of the short term of the weekly basis here, you see you're already up to 50. So, and if you follow my cursor across, that's a pretty significant drop in a short amount of time, with the positive indicator here about as low as it's been. Last time we got this low was in 2018 during that decline, and then eventually that led to a rise in gasoline prices from $1.25 up to $2. It's a pretty significant jump in price here. So we'll see how this plays out in this round trip that we've made from 250 that started earlier this year, and now we're back down to that, because again that has an impact on consumer sentiment. You would think investor sentiment, especially as it impacts overall CPI levels. Keep in mind though, when you look at the CPI component here, right, this is the important component that we've been paying attention to see if it's going to start having an impact on the overall inflation rate. And obviously it came down to 396, but you can see it's still really, really high, and it has to come down quite a bit to get back to, even you can see the COVID low point, the index didn't even drop below that 2016 low, or even the great financial crisis low when it got below 160. Both those times here it got down to 168, and we are still more than double that, 168. In fact, from the pre-COVID peak at 250, we're still at 400, relatively speaking, to kind of give you an idea of what that means. And I'm just going to make the math easy to work with here. But that's a 60% increase in gasoline prices from the pre-COVID peak in the index. So that kind of, that's a, in 320, you can see was the high point prior, and we blasted right through that. So it's going to come down in August. You expect that it will. How much it comes down, where it ends up being relative to previous highs, that remains to be seen. It's been great to get down to this level, and it's had a good impact on equities up until the last few weeks. But now the question is whether it's going to be able to be maintained. If you look at the, let's see here, these sectors. Sorry, I hit the wrong one. This one. If you look at the sectors and how they performed today, especially, so let's go out to September. You can see we had a good move higher in energy and materials and financials initially. Everything fell except for energy and materials. Interestingly enough, because of the strength in the dollar, you wouldn't expect that to be the case, but they're holding up much better in an inflationary environment than technology, especially communication services, which has been weak all day long. But technology has been lagging the S&P since it broke down, and same thing with just consumer discretionary. Staples, healthcare, real estate also down here too, as long with utilities. It's a pretty broad selling when you consider the implications of even the safe haven sectors falling down that much. Here's the entire week: utilities, healthcare holding up better, staples, holding up better. Energy, in fact, was a pretty significant loser. Remember, commodities were down quite a bit. Materials and technology matching each other for 5% declines on the week. So when you look at it on this chart, the 12 grid chart, again, remember how we said when things get bearish, everything goes down. Well, you pretty much have dark pink shading across the board. Healthcare or utilities and energy still don't. Utilities does have light pink shading, yellow line. Energy has light pink shading, but not quite the yellow line yet. We're still above there. But I mean, look at communication services, technology, healthcare, staples, even well below their moving averages. Red lines, real estate, materials, industrials will probably turn red with discretionary pretty soon. When they're all showing the same pattern rather than a rotationary pattern, then it goes to show just what kind of market we're in, just how bearish we actually are. All right, now let's take a look at our trade idea of the day. Let's take a look at Las Vegas Sands. You can see that it's also dark pink shading and a red line on the market forecast. So, the intermediate line's dropping into bearish territory. That gives you the dark pink shading. We're below a falling moving average. That gives you the red line. We're easily below the moving average, more than 4%. In fact, all three lines are in. The intermediate lines cross below market sentiment. So we're kind of in the beginning stages, potentially, of any kind of move to the downside, because it's still, we're in a bullish move here. The last bullish peak we had on market sentiment was back here in February, and obviously this would be a lower high point considering the near-term peaks that eventually just got weaker and weaker and weaker, the bullish near-term peaks there. When you look at the long-term, the weekly chart, it's been in a death cross environment for a long time since, we had the brief little reopening trade right there, but it's pretty much been in the bear market itself. Las Vegas Sands has been, when you look at its 3 green arrow chart here with the lines broken out, you broke below the 50. You broke below the 50-day moving average. You broke below the point of control. The 8 and 17-day are below the 30 and below the 200. So you are you've got some bearish potential for this. You can see this long-term black line there, that 23% retracement comes from all the way to the bear market decline. So obviously you rallied. You never did get back up above the 78% to really get going. So Las Vegas Sands has really been struggling. You can see we've touched multiple times this kind of $35 level, but it's been bearish ever since. It's been bearish ever since, and now again you can see there's not very much below here. If we were to break this line, there's not very much support if we were tested the 52-week lows below that and get it, like I said, getting below the point of control, and other indicators that are also continuing to be bearish. You can see you're above the cloud, but you've been now below the blue line. The green line's crossing below the blue line. You had a bullish trend, it's gone, and you're flirting with getting into the cloud. Looking at the DMI for Las Vegas Sands, you can see that we're above 25 in the negative. The positive indicator has dropped below 20 for the first time in a while. We were bullish this entire time. So more, pretty significant bearish. So what we decided to do here was to do a little bit of a bearish trade, but do a bear call spread, but an at-the-money bear call spread. And what this allows me to do is normally we put $1,000 at risk at a maximum level, right? That's our kind of worst case scenario. But what we decided to do here was position size for 3/4 of normal risk. But because we're at the money, I can get double the reward. So typically when we're this far away from expiration, if I can get 50% of maximum gain before the 20-day window, I'll take it. So in this case, 50% would actually be a normal return for $1,000 of risk, and I'm doing a high probability trade like this. This is pretty close to high probability. So I'm getting double the reward for 3/4 of my normal risk, which means that I can get my normal reward at 50% for 3/4 of, and again at the 50% mark. So it's set up kind of nicely there, especially considering we still have a lot of time to go before we get to expiration date. All right, that wraps us up for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forums. Open up any new thread with any questions or comments you have. Reply to anybody else's thread. And let's keep this conversation going in between videos. As always, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Also, subscribe to us at marketscholars.com for free. Like us on Twitter and Facebook as well. Have a great rest of your Labor Day weekend, everybody, and we'll see you all next time.